Hello guys, welcome again. Welcome to another lecture. I hope you enjoyed the last lecture and you're learning a lot, and I'm really grateful to have all of you guys here again for another lecture. Today I'm going to talk to you guys about something quite exciting. I've been wanting to do this. I've been wanting to kind of structure this in a way that it's understandable, because the one thing I'm going to guarantee you today is that you're going to hear something that you have not heard from anyone before in trading. To me, it almost feels like I am giving you something that the entire sell side, or let's say the entire institutional or brokerage community, wouldn't want you to know. And they wouldn't want you to know this because it has an adverse effect on the way that they see business. So whether they're a prop firm, whether they're a brokerage, whether they're something else, as long as they're not on the same side as you, in other words, they're not retail, they would rather you didn't think about markets in this context, right? Because that's to their benefit. For those of you doing prop firm things, you're gonna end up losing a ton of money, right? So you end up paying for the challenges, failing them, essentially, or getting your live account, blowing it, because they don't want you to know this, right? And there's nobody teaching this. I've listened to so many people who mentor other people with huge YouTube channels. I know people who are 7-8 figure traders, and none of them, absolutely none of them, are teaching this. And I'll be very surprised if someone who's been mentored by someone else, or has done a course, or has done any kind of education, free or paid, I'll be very surprised if you know this or have this kind of context around your trading. Because I guarantee you, if you did, you won't have a problem with profitability. You wouldn't need to be watching this video or this lecture right now. Why did I say this? Well, from everything I've seen, and I know, and I'm being a bit general here, and I know people would have stumbled upon this in some cases by pure accident, and they've been able to implement it and they've become successful. But on the basis of that, they're going to find it very difficult to give that knowledge to someone else. They're just going to feel, and I've grappled with this for a while. Like, people who've been privately mentored by me, I've essentially got this message across. But in public spaces like YouTube, where I'm trying to teach you something more conceptually, it gets really difficult. And often traders feel frustrated if they're learning a lot of concepts but struggling to apply it. And if they feel frustrated, what they tend to do is say to a mentor or another trader, or if they're on a desk, a senior trader, and they'll say, can I just see what you're doing? Can you just trade live for me so I can see you making the money that you say you make? And in all honesty, that makes perfect sense. There's a problem with that logic, but I'm going to come to that a little bit later on. There's a problem with that logic. However, even if that trader was to do that, often other traders feel they can't replicate it. And it's not a problem with what the trader did, right? The trader absolutely probably knows what they're doing. The issue comes when the trader doesn't want to tell them exactly why that trade worked for them, and it hasn't worked for whoever's watching. They could, because they've stumbled upon what is the obvious truth. However, they're opting not to make it clear enough, because then the gravy train can keep going, right? So they're not making an attempt to even conceptually embed in the other person's mind that they need to behave in the market in a specific way. And that's what I'm going to reveal here today, because I think for me it makes sense at this point based on the sheer number of people who want to be involved in trading. I don't really think that I'm going to be at a disadvantage telling you. I'm going to give you the frame of reference that you require in terms of you actually applying that frame of reference, that's going to be up to you. I'm not going to spoon feed you every single thing, right? That's where my value is. That's where people who want that, that's where they're really going to have to see my value. And it's going to make sense in a minute, because I think there needs to be a line. Trading is a difficult game. It's incredibly hard. And it's hard because of what I'm about to talk to you now. A lot of people can conceptually understand this, but application can be a whole nother thing. And no one wants to talk about that elephant in the room. Everyone wants to pretend that trading is easy if only you do a set amount of things, or if only you behave in a specific way. I'm here to say that is not entirely true. There is a specific way to behave, correct? But on the same token, it's not that simple as I just behave that way, that's not. Okay, I'm going to take away the suspense. Now, there's something that I've always tried to keep at the back of my mind once I discovered this, was that probability to be a profitable trader, I'm going to start there. To be a profitable trader, you need to have an edge that essentially means the probability of a specific repeatable event happening is very, very high. Secondly, you need to add that to the probability of a scenario occurring being very, very high. So a desired scenario. So the scenario you desire to occur, that also has to be very high. And it's going to be rooted in some statistical benchmarks. Okay, I'm going to try and say this in a less complicated manner. Often my challenge in communication is that often the way my brain works is I tend to not say things in the simplest of ways. So I'm going to try and go back to that initial statement and see if I can put some clarity on this. And I'm going to show you exactly what I mean from the lens of the way you currently see the market, because we all used to see that market that way. And it's irrespective of whether you've been watching the lectures so far, market profile. I'm pretty sure conceptually you understand a lot what's going on, but the kind of questions I get are a lot around application. And I promise you, in future lectures, I will be delving a lot into application in a way that is going to be clear and understandable, especially when it comes to developing process. But this bit is a bit that it cannot be ignored, right? This frame of reference I'm about to give you, it can't be ignored. So I'm going to go over it again. Repeatability. Something needs to be repeatable on a regular basis, right? So whatever your strategy is, it has to repeat consistently. It cannot be random, right? It can't be something you did today, but you're not sure if that scenario is going to show up tomorrow. You can't have that uncertainty. You need to know that this specific event repeats and repeats at this specific time or juncture in the market. Very important, because this brings into the whole game a factor called repetition. How many repetitions will occur? Very important, right? So you need to know, is this something that repeats? And in order to know that, you probably have to have access to a lot of data over time. Now, as a new trader, I'm going to totally appreciate you just haven't done the work in order to have the data of the repeatable event. And most traders don't even know what the repeatable event is. They need to find a repeatable event. That's a mountain in itself. You want to make sure that the probability of the scenario that's going to develop from the repeatable event, so that's the profit, your expected value that you're going to get from that event, right? So the profit you expect to make, or the gain you expect to get from that event, you want to make sure that that gain can actually occur, or that expected value is what you think it is, right? So the probability of the actual scenario occurring has to also be quite high and regular. So I suppose this is the bit that most people can probably get across a lot better, is that, well, you need a 1 to 2 risk reward, for example, as an expected value. You're expecting to make, twice whatever you risk. So if you risk $100, you're expecting to make $200, right? So that's an expected value you're plotting. That's what I want to make. That's your desire. However, the market you're trading, is it possible for you to achieve that expected value, right? So you need to actually know the expected value of the market. So if you don't know that, you're going to be out of kilter. One good way to determine that is by using what we call range or volatility, right? Better description. So if you think that a market has X amount of volatility, then over a given period of time, then it will tell you essentially what's the range this market can actually do. Now, I've communicated this concept through previous lectures, right? I have. But to a lot of people, that might have been a glossed over concept, and I apologize for not maybe emphasizing that point a lot more about range. How far can this market go? But that is really, really important, because different markets have different range abilities, so the expected values are different. They behave the same, right? This is where the other mentors or other courses and stuff, they get this bit wrong, is that they don't understand that the person they're talking to, they may have stumbled on this concept, but they don't get that the person they're talking to has absolutely zero clue about this concept. In fact, a few years ago, I listened to a podcast from a very, very successful trader, right? Just listening away, it's a very old podcast series. And the trader was saying that one of the things they don't hear often enough in markets is asset volatility and range. It is not even talked about, right? But this is going to govern expected value. So you need to know how far this thing can go, so you can calculate what your potential expected value, and you need to know that over a series of days, possibly even years, where the market has declined in volatility and has increased in volatility. I could accurately say, I'm going to give you now a concrete example. I can accurately say that the volatility of cable has gone down maybe by half, by 50%, relative to where it was when I first started trading. So somewhere over a 16, 17 year span, we've seen the volatility in cable expand at points and decline at points, right? But largely the overall volatility of the asset outside of major events has declined dramatically from, let's say, 2011 even, right? So this is a concrete statistic that I'm aware of, that cable has lost volatility. So there's, I'm going to have to adjust my expected value to what is the current volatility of cable. You can only have that insight if you've traded an asset for a long time, and over time you've started to understand how that moves. So that in a way lends credence to the fact that sticking with one asset is sometimes not a bad idea. If you're a multi-asset manager, then obviously you have a lot more to get to grips with it now. So you have let's say you have a bigger brain for all of this. But if you're not, and generally you believe that, well, I don't have a massive brain for all of this, then fair enough, right? You don't necessarily have to do multiple assets. You can still make money just trading one single asset, right? It's not a problem. But you need to know the expected value. So we've got two things here, and hopefully it's a little bit clearer. We need to have a high probability that a specific event is repeatable. And then we also have to have a high probability that the desired outcome, the expected value, or the scenario occurrence is also quite high, right? So the ability for us to achieve that is very high. Now, if we combine these two things, the inevitable outcome is profitability. And why is that? And that's because, one, the repeatability of the events now sets gives a high probability of having a 50-50 sort of loss versus win, or win versus loss, right? And let me explain this, let me elaborate a little bit more, and I'm going to show you on the charts in a minute, because this bit is going to be important to the rest of the lectures. So 50-50. Let's say you had a repeatable event that happens every single day without fail. One repeatable event that's going to be a tradable opportunity will happen. There's not going to be a point where it's not going to happen. And if it's not going to happen, you need to know exactly why it didn't happen, right? Because there's usually a reason why it hasn't happened. And if you can't identify that, then it tells me you haven't looked at this properly. You don't know what the repeatable event is. So you essentially can't tell why it didn't happen today and it happened yesterday. So a repeatable event means, let's say it happens every day. Essentially, that means it will happen 5 times a week. There are 52 weeks in a year. You can do the math. So it means that you've got approximately, let's say 250, 270 trading days in a year, right? So that's 270 occurrences in 1 year. If 50% of those occurrences are wins and 50% are losses, then effectively you have a repeatable event with a probability factor attached to it. I.e., out of those 270 trades I'm gonna do for sure, right? I'm not gonna miss a single one. There's a 50-50 outcome. The more spread out the repeatability is, the more likely it is that you're going to have to spend more money to achieve your expected value, right? And I'm gonna elaborate on that a little bit more, right? This is really important. So I want a repeatability that is a lot. So the general analogy in the industry is trade small, trade often. By that, I don't mean trade small, trade the 1 minute chart to trade often. No. What I mean is trade small, but make sure you're trading repeatedly every single day. This is important. Now, I have heard, right, and we're all guilty of this, to say that you don't have to trade every day. That's just us trying to make the retail trader not feel under so much pressure that often they're going to feel like they're going to take multiple trades in a day. So it's to kind of manage expectation, because you know it's really difficult for that new trader. So if they feel they're under pressure to trade every day, what tends to happen is they're going to make a lot of mistakes because they don't really have a proper framework. They don't have a good frame of reference. So as a disclaimer, right? So educator or mentor kind of person that is a public personality, they don't want to put their public personality profile at risk by essentially saying that you need to do X, and the trader falls under pressure, they lose a lot of money, they go and they speak about this openly and say that public personality, quote unquote, says I should do X, and then I did X and then it was all a disaster, right? No one wants that. So everyone's going to guide you in the direction of conservative behavior. I understand this mentality totally, but it's not the greatest idea for someone who's coming to trading with a view of making money for themselves, which is the only reason why people come into trading, is to achieve a degree of financial freedom, whatever that looks like for that individual. But that's why they're here for the money. Unfortunately, there's nothing else in trading other than money. You're consistently moving money back and forth. There's literally no other benefit from sitting here and doing this. It's the reason why a lot of us like to teach and lecture, is because, Jay, it's so soulless, right? All I do is make money, and you know, it's just fun. Doing something like this is fun. It's as fun as it's gonna get in this industry. Everything else is just about money. If you're kind of this really money hungry person, and maybe something in your childhood or something else has made you this way, then you may enjoy just the aspect of making money. But if that isn't you, and you've come into it just to better improve the the lives of your family, yourself, and that's why you're in the business, then you're gonna want to do something else fun, right? Like you go out, you have fun, that's different, but you'd want to do something fun in the industry, right? Where you're enjoying it. Making money is fun to a point until you've made money consistently, and it's not really that exciting anymore, right? It's just not. But when you're getting to the stage where you first started being profitable, the dopamine rush is so high that you're always like, oh yeah, I just got profitable, this is amazing, I can really make something of this. It's a little bit different when you know the path to being consistently profitable. So the framework I'm trying to lay out for you now is that path, right? But you're gonna have to walk it. What I'm not gonna do is say, this is what I do, you do exactly that. There's a problem with that, right? It can't work that way. And the reason there's a problem with it is because people, one, live in different time zones. So, two, they have different life structures. The way I trade is based on where I currently live, my lifestyle, and my own desires. And so I've developed a repeatable event, high probability occurrence of expected value within my time constraints or my forcing points. And that's it. So I might know structurally everything else about market profile. I might know structurally a lot of things about order flow in markets that I can teach you. But these are just all structures. They're frames of reference that should allow you to build a trading system that is going to revolve around your lifestyle. But it has to be rooted in these fundamentals. It has to be repeatable, and it has to have a high probability of the expected value occurring. If it doesn't have these two things, that strategy is not going to work. Right, so I'm going to make an attempt, as difficult as it may be, because this bit is difficult, right? I'm going to make an attempt to see if I can illustrate this a little better. Right, so I've got open a chart here of cable. I'm going to use a candlestick chart for this, so forgive me, because this is the way a lot of people visualize the market. So typically, if we think about what we've been discussing, right, a lot of mentors would say, for example, let's talk about the most common thing today that we're all talking about now with trading, which was obvious to people who've been trading for a long time, but it wasn't so obvious to new traders. And for some reason, despite so many mentorships, the whole concept itself got ignored, even though it's something that intuitively we all know. And that's trading and running stop losses, right? In the old days, people call it stop hunting, right? So you want to join the stop hunt. Fair enough. That's an easy concept to understand. Stop hunts occur all the time. But a question that you should ask is it repeatable every single day? So do we see this every single day? Well, there's an argument that yes, a stop hunt occurs every single day. But is there a high probability that the expected value from that stop hunt tends to be quite high and you're going to be able to realize it? Well, this is the bit that often people will say, well, I don't know, right? So we're going to look at a few days and ask ourselves, did we see a stop hunt on that day, and did we get the expected value on that day? It will take a lot more data go through to come to a conclusive decision, but hopefully over the next couple of look backs, you should be able to determine whether you would have been able to execute on this. Now, as part of the framework of repeatability, right? So we can see, so we're going to start with this day here, right? And that was the 4th of June. So on the 4th of June, let's see where we saw the possible stop hunts. So the first one which is here, was this one here, right? And this is on a 1 hour time frame. So let's say you're doing all the cool stuff, you're going one time from beneath and all that good stuff. That was the first one. But what time was it? It was at 3 a.m. in the morning, right? We saw the evidence of the hunt at 3 a.m. in the morning. Well, that's 3 a.m. in London. Depending on where you live in the world, that could be a very odd time. There are not many people I know. I trade Asia, right, because of where I live in the world, and I'm using a model to do that, which has all those things, but it's not this, right? Because this wouldn't work for me just because of the time zone I'm in, and I'm sure we all can start to understand that. So as a trader who's been in the game for a long time, you're likely going to have different models which work with different scenarios and have different probabilistic edges. It might not be your best probabilistic edge, but if you're in a time zone where that is the edge available to you, that's what you got to go with. Unfortunately, you can't make the rules, right? The rules have already been made. You just have to play by the rules. So I can see that's 3 a.m. That is not available every single day. So it's not repeatable. So whilst the idea itself exists in this time frame window, someone in London is not going to be able to take advantage of it. Now let's look at what happened in the London Open. Was there any sort of stop hunts or available in London? Let's take a look. And by a stop hunt, I mean we have to completely clear the highs, right? So we can't do equal highs, right? So if we look here, there was equal highs almost, and then a pullback. So there wasn't technically a classic stop hunt. So this would have brought a lot of indecision to a trader. Should I go with what I've seen, or am I wrong and am I going to expect expansion? This is reality, right? So as a result, a London trader might not be able to take a trade that day, or they will see this big candle in disappointment that they haven't seen a draw. They will be, well, I'm going to go long. We eventually go above the high again, right? We don't clear it cleanly, we pull back. So some traders, they go short. It's now a disaster, they get stopped out. So this day was very unclear if you were a London trader. And in fact, if you'd opted to go short on a liquidity model, that would have been 2 p.m. in the NASDAQ, right? You're technically a US trader. So you've come from being a London trader to a US trader, and the only real play on stops that we saw was in the Asian session. Once we ran the stops and came back there, I'm not expecting us to essentially go back down again because we've already run stops up there before, right? So conceptually, we may understand all this information, but from a practical point of view, we couldn't take the trade. So that means that this liquidity sweeping idea is not a repeatable event within the time frame that most traders will be able to trade, right? Because it's occurring in Asia. Now let's go to the next day. Can we see a similar event that we could have taken advantage of in a typical London session or European session? Well, let's first look at the first one potentially that we saw. So here we had what looked like a consistent pull and then a rally up, right? And that only became evident when we had the push up here, right? And that was in London at 8 a.m. We had a pull on what looked like stops initially, but then we kept closing up higher. So that gives us the idea that we're not essentially getting a draw, or we're not essentially taking the stops that are high. So we're not really drawing the buy stops. We also have stops here, so that's going to be a more likely place that we would look for a draw, as opposed to here, because this is kind of more shorter term liquidity. So that didn't really come till 2 o'clock in the NASDAQ, where we go over and then we finally settle and give a trade signal to go short at 0600 pre-London and in Asia, close of Asia. To a lot of traders, this is no good either, because 6 o'clock in the morning, we probably sort of draw in the NASDAQ, and your setup really only starts to shape up. So I think there might have been a clue that we're going to go short from about 8 o'clock at night in London, but most of the time no one's in front of their trading terminal at 8 o'clock at night. And then through Asia, we pull back and then start to break down. So the people who would have been able to take advantage of this would have largely been in Asia. Did we have an opportunity in London to see a draw? No, we didn't. Right? We did not. We had what could have been classified as that at 11, but we know we don't trade lunchtime. So conceptually, I have all these things in place, but I simply can't find a repeatable event from using the liquidity model because it keeps occurring at different times. So what would be the best way to use something like a liquidity model? Right? So if we're looking for a draw, then the best way to use it, and that's why we use market profile a lot, is to be able to eliminate some of these issues. But the best way to use it would be probably on a daily frame. Right. So if we pull back to a daily frame, and delete some of these things on my chart. Right. So if we pull back to a daily frame, we can then see that if we get a draw and liquidity on the daily, then we can position on a daily frame using maybe a smaller time frame as a point of reference, and then we can execute on that trade. So that's a better way because we're looking at each day as a reference point. So it's more repeatable from an execution point of view, because I don't necessarily have to look at the intraday, so I don't have to necessarily trade in Asia or London. I just need to have a position at a given price, regardless of the time. So I might be able to maneuver around that and say, well, I'm a little bit late. So let's say that I've seen a draw here and I think we're going to go lower. I can easily look at my market profile and go, okay, I've got a draw on liquidity, which is this trade here. I'm going to set a limit order on the profile, right? So if we trade there, I'm just going to go short with risk above the high, and I'm going to look to get out here for a specific scenario occurrence. Now the repeatability of that would be pretty high, right? And we can easily see that. But you're going to pay a risk premium for making this trade. Because this trade has a higher probability of working out, you're going to have to risk more on the trade in order to achieve your reward. So you're essentially going to need to put more money down, because this, if we look at how often this happens, so let's look at all the potential trades that we could have taken due to draws on liquidity. So the first trade would have been this one, where we went up, pulled back within the initial block range, right? And at this point, if you went short, you'll be looking at a drop back to the low, which should be about here. But look at all the volatility in between, right? So it means that your overall equity shifts, right? You're accommodating a lot of volatility back and forth to get the expected value. So it's a risk premium, right? You're paying more in order to get a more certain outcome, right? And here again, you can see that we had another draw here. Look at the difference in days. So we had to wait what would have been 10 days to go from the first trade to the second trade. With profit eventually across both trades, the whole cycle would have been 16 days, so 2 weeks. So essentially you've got a trade a week. There are 52 weeks in a year, 52 trades. You're going to have to risk more to get a higher expected value so you can pay yourself at the end of the year or the end of the quarter. That's the problem we have when we start to think about longer time frames. Again, this is something that most educators are not going to talk to you about. They just say, oh, trade in longer time frames because it's easier, and I don't trade intraday time frames anymore because I'm a 6-7 figure trader and I don't need to do that. In fact, everyone who trades with smaller time frames loses money, blah, blah, blah. Bullshit. Bullshit. That's not how it works. It's not that everyone who trades a small time frame loses money. Everyone who trades a smaller time frame trades it like they trade the longer time frame. This is a problem. In a smaller time frame, you need to put more things together. And like I said, it needs to be repeatable because it has to happen every day. And that's if you're trading a 1 hour time frame, right? And if you're trading a 5-minute time frame, you should really be taking your cue from a 1 hour time frame, because other than that, you're going to have to devise a repeatable event that you can picture happening every 5 minutes and you can achieve the expected value for. That can be a bit difficult. You'd have to put a few pieces together, and because it's shot a small time frame with the expected value being incredibly high, you're also going to pay a risk premium. So on both ends of the spectrum, you're going to pay a risk premium. So for me anyway, it makes a lot more sense to look at the time frames between a 5-minute and a 1 hour as the time frame of 5-minute and a day as the time frame of your reference, because with a day you pay a slightly higher risk premium and you also stay in the trades for longer, and you don't have enough repeatability for data reasons. So determining that probabilistic edge gets a little bit difficult, because imagine 20 trades for you might essentially span a couple of months, maybe even a whole year. Problem with that is that you need a whole year to be able to determine probability. When you have drawdown, you're going to be in the drawdown longer. So again, if you're the person who wants to be able to pull money out of your account to sort out your day-to-day life, this is not going to be feasible for you. You're going to have to be a little bit more depth of planning, and that's why you hear people talking the stuff like, oh, you need to have 2 years worth of savings. It's because they've already gone through this mental loop that actually, how the hell am I going to make money from this thing if I'm going to have to make a withdrawal every 6 months, right? And I'm going to have to be in drawdown for thousands of dollars over a 2-3 month. At some point, you're going to run into a brick wall. Either someone is going to flag in your personal circle that you're crazy and you're losing your mind, and you're more likely to quit trading. And it all grinds down to this exact thing I'm trying to say, is that you don't have a repeatable situation that happens every day that you take advantage of. The tools I'm going to teach you with Market Profile will allow you to be able to build that repeatable event. You're going to be able to see it. And a lot of what we're going to talk about is going to kind of skim on that. But the value, like I said, my value is in my ability to have stumbled upon, wondered upon, devised, whatever. I have that. That's about, I have that. And that's the only reason why I'm profitable, and I know it, right? There's no doubt in my mind that I didn't have that, and if I was trading the way most of you are trading, I'm not going to be profitable. Impossible. It's not even feasible in my mind that I could be, because when I have to manage my own day-to-day trading, I can kind of say what goes wrong. Like, for example, if there's a day, for example, that I don't trade, right? And let's say that, for argument's sake, when I first started trading, or let's say when I first discovered that this is the way I need to be trading, where it's not a time where I was managing money, it wasn't any of that. I'd kind of just come out into the retail world from what was an institutional cloak. I got to find my own way. I got to fend for myself. The issue now becomes, how do I do that without the general protections that exist in the space? Without endless capital, how do I do that? Right? So at that juncture, if I did not have or manage to put together something repeatable that I could do, then it's obvious that I'm not going to be successful. So when you're coming from that starting point, you have to think really hard on it. So essentially what I'm saying is, I'm going to give you the recipe, the sauce, the structure, but you're going to have to execute it, right? You're going to have to put it together. But that's where my value is, right? Because I had to put that together. So that's not going to be something I'm going to give you for free. Impossible, right? You don't have to come to me and ask for it. You don't have to want to be part of a mentorship. You don't have to do anything I have to. You don't even have to get a market profile too. But that is the one thing I'm not going to give you. It's not possible. You won't get that bit for free, where I where I walk you through the steps and I say, you know, you need to do it at this time. This is exactly what you need to do. You know, sometimes you find it hard pressed to give that to your own children. That's the reality of it, because you're thinking, you know what, you have to show the willingness to put in the work, and you need to get to the point where you've put in the work and you've gone like, okay, I've got everything conceptually. If I had this one little recipe, I think I could put it together. And that's if you can't piece it together yourself, right? Then you need to talk to someone about it, and then you need to know you need to get a recipe. But to be honest, most people can build it a reference conceptually. And once they've done that, it becomes now, can I get that expected value every day? And there are models to do it, regardless of the session you want to trade and so on, right? But like I said, that's not something you're going to hear me talking about. And I know 90%, 100% of the educators are just making trades out there, but not telling people how they're achieving their returns. It's just what it is. So anyway, so you can see that with a daily profile, that the repeatability, the expected value is definitely there, right? And this is what draws people into longer time frames. You can see the expected value. I mean, look, if you were to get that, here was a draw here, and if you were to go long here, for example, and put your stop down here, well, you know, the expected value was pretty high, right? That was pretty high. On two lots, look at what you're looking at, right? 2.3K, you're making 6.6K. Yeah, makes sense immediately why you need to be on a frame like this. But the expected value is easy to determine, but look at the risk premiums to take a trade, right? Okay, you can size down, but look at the distance between occurrences. You're not gonna have a lot of trades on. Of course, initially, on a good run, your probability of success is gonna look really high. Maybe you're gonna, if you were diligent enough and you took both of these trades and you did exactly what I said, it's 100% win rate. But sorry, mate, it's just two trades, right? And it is about how far back in time, like, okay, so now we're going up, right? Let's move to the right side of the chart, right? So we know there's liquidity up here. If we get a good draw, close back in, you go short, where are you gonna target? Likely down here. If we're still relatively bullish on cable, then you can target down here, right? As where we're gonna go for the next draw. Whatever you choose to do, however you choose to play the game, it doesn't matter. You're not going to get another opportunity like this for another couple of days when the market goes down here. And that's providing that trade ends up as a successful trade. If for some reason we're wrong, we pull back and we reclaim the stop area and we keep going higher, then you get stopped out. There is no way for you to recover that trade today. You need to sleep on that loss for a couple of days and then see if the market can give you another opportunity. You can't do that if you're looking to use your trading kitty to pay your bills, which is essentially people want to trade and make money. I've never understood this. Like, oh, if you want to trade, just trade for fun. Don't worry about making it something you want to do as a profession. Yeah, just trade for fun and, you know, go to your day job. And what's the point? If I have to go to my day job, I'd rather put all my attention in my day job, see what I get out of that, and then move on, right? You don't have to do trading. You can invest your money into something else. This is not something you need to do. So the bottom line is that if you're trying to engage in this kind of trading, leverage trading and all of that, it's because you want to, any kind of margin trading, you want to make money for yourself, right? If not, you just buy cash equity stock from your paycheck and you probably do well anyway. We're in an inflationary market. You might not even need to do any of this. But if you're trying to do this, I'm assuming that you probably hate your job. It's a non-starter, and at some point you want to either retire into this if you're an older person. If you're slightly young, you want to probably go places with the knowledge and the skill set you have, and that's what you're trying to build. Or maybe you just want to start an education business around trading. Whatever it is you want to do, you want to develop the skill set to do it, and you want to be able to be good at it. And that essentially means that you're going to have to make some tough decisions, and you can't make those decisions if you can't make money from your trading. Like, it's just a nonsensical thing to think of. Anyway, this is something that I like to have at the back of my mind. And if I'm talking to traders, this is what I have at the back of my mind, is that I'm sure everyone's here to make money. So these kind of ideas right, where we're just looking at liquidity sweeps, they need to be done on longer time frames. But that comes at a cost, right? There's always a risk premium to pay. And that's what you're paying for a longer time frame. So you need to know that. If I double back and I go into a weekly time frame, right? So here we saw that initial draw. I thought we were going to collapse and go lower. That didn't happen, but we still didn't give a signal to be short because we didn't close under the highs here. So we didn't attack this block of sell orders coming down. We just didn't get back into that range to reinforce the point. So we're still going higher. Now there's expectations we could draw liquidity up here. We could even get into the 140s. But as soon as we start to post highs and build a consolidation and go up, then it could be weeks before we see the next trading opportunity. Especially if we're looking for draws on liquidity, which will be your designated repeatable event. There's no point trading up here short or getting eager. You've got to wait. So that could be weeks of waiting for a trade and not making any money at all, just waiting. And the trade shows up, you take it, maybe it's a loser. Maybe we come down, we enter the zone, we don't keep going, we don't retest these lows. In fact, we just pull back on a sweep and we go higher. You're done, right? The risk premium on the week, now that's no joke. But on the flip side, we can see there's several occasions, right? So again, if we go back, and again, assess the distance between behavior, right? So again, look, we had a draw here. So we initially went above the highs, very similar to what we saw here. But again, we went above the highs and then pulled back in, right? This is a great shorting opportunity. But look at the risk premium on this. 6K, look at what you got, 19 though. But can you put a 6K? Of course you can size down. But this whole move went from September all the way to January. Now, you know what? Like, there are people who are on this trade and maybe they kept shorting all the way down. I'm sure there are, but they're definitely not 5-figure, 6-figure even accounts. They're probably much bigger. Maybe a 6-figure account could push it if you're comfortable with the risk, right? But most people coming into trading don't have 6-figure accounts at the start, or even if they do, they're not willing to put 6 figures into trading. They're just not, unless they're coming already from a position of gain. They already have a lot of gain. But again, this is it. So this repeatable event might be a little bit extreme using a liquidity model. We might have to think of some other idea. But the weird thing is that there isn't too many ideas that you can explore on time frames like this, because everything is very similar in terms of what the market does on these time frames, right? So either way we would have to rethink it. And equally, if we're on a 4-hour time frame, that's going to require a different model. So I'll give you an example, right? So I worked with a trader quite some time back, right? And that trader likes to trade 4-hour time frames, pretty good trader. And one of the techniques that he used to apply on 4-hour time frames was trading pivots. And I found it interesting. And this is something I would often talk to my private clients about who might be trying to build that repeatability. I feel comfortable talking about this one because this is not the icing on the cake, and I barely talk about anything to do with pivot points at all, right? And when I say pivots, it's not what most people think of as pivots. So what I would do is I would look at, right, and that's based on that learning from someone who was a stellar trader, right? Absolutely stellar. If the market does a higher high, right, and then it does a lower high, lower low, the break of the central low, right? And I'm going to zoom in on this, and I've got a lot of lines because I've got this chart drawing synchronizer which puts everything on every other chart I draw. So sorry if it looks confusing, but I want you to focus on this line here, right? So this bar here, let's zoom in. So we went up on this 4-hour window, went up on this 4-1 and failed, and then broke the low. Now The general idea is the bar that broke the low, I'm looking to get a short position on a slight pullback into it. That could be anywhere from 30 to 50% of it, which stops above the high of the bar, right? And I'm looking to short it to the low of the previous bar or the open of that bar, depending, right? In this case, volatility of cable is a little bit tight. It's about 10 pips. And because we're looking at it on a 4-hour frame, I can look for at least the low, and I'm going to be executed from about here. So as you can see, there's a little bit of the risk reward is not exactly a 2-to-1, but it's a high probability occurrence. So the repeatability of it is very, very high. It occurs very regularly because it's a 4-hour frame. And the expected value is a little bit lower because this has a higher occurrence, right? So his idea was to consistently look for those pivots within a 4-hour frame on a specific asset. Now, I'm not saying that he was a cable trader. I'm just trying to illustrate this on cable. He used a different asset. And it's possible to look at a market within these lenses, right? So that's an example of something that's repeatable. And if it's tested and you can see that there's a genuine edge there to get your expected value, then that's something you can look at executing on. And because it's highly repeatable, you're going to see it often enough for you to build a statistical database. I hope I'm making sense, right? Because this is going to be an important factor. Now, there are various ways to come at the market when we think about things in this context. Okay, cool. Now, I hope I've brought a lot of perspective on this lecture. A lot of this lecture has been about knowing what you need to do, and going forward as we talk through the profile, it's about knowing what you need to do. You need something repeatable, and hopefully as I build the structures around these, you'll be able to see that repeatable event, right? A couple of you have already asked me questions about bid stacks, right? Is it better to trade into bid stacks and offer stacks? And I've said, well, you've got to be objective about these. You've got, but I'll talk through future lectures the best way to structure that. Whilst we've spoken a lot about liquidity, as you notice, I'm using a profile, so I'm able to show you the daily draw and how you can trade that in the smaller time frame using my time trifecta. This is the reason I have the trifecta. It's the reason that I say volume, time, and liquidity. Let's see a setup of all three. There will be an opportunity to trade almost every single day using the trifecta. And this is repeatability. And that I also say that the profile allows you to judge the expected value coming out of each session. Really important. So let's say, for example, we split this profile, right? This is the NASDAQ session opening now, right? On the close of that, we're going to be able to have an indication of what this market will do next. That's using a time trifecta because this is the NASDAQ. Could you build something repeatable around that? Hint, hint, hint. You probably could. Could you get good expected value out of this trade? Understanding some of the concepts we spoke about, you probably could. Look at what happened across yesterday to today. What did we have? We had Asia posting a low, London opening, closing higher, continuing upwards. We talk about the concept of value. So we're likely to see a value trade, going to value high, off a stack. Market pauses. Is there expected value here if you were to get long on seeing the draw on stops? And you put a stop here, that's 27 pips, 73 pip run. To the US Open, it's a 60 pip run. Could you get expected, this was a news event by the way, that was the inflation report, but driving into the inflation report, was the expected value there? Absolutely. Was the trade there? Absolutely. Is this repeatable? Absolutely. Do you think you could probably form a repeatable idea around the London Open? Probably could. Was the repeatable idea the draw on stops? That wasn't a repeatable idea. That's a repeat. That does repeat, but it doesn't repeat every single day. Does the London Open happen every single day? Of course it does. Could we build a trading theory that we could backtest around that? Of course we can. Time is a constant feature in our lives, so we could do that. If we can't do these things, trust me, you're never going to be profitable. It's just the way it is, because you might see this opportunity in the London session, but tomorrow it doesn't occur at all, right? So again, what do we see here? We could build an idea right now around NASDAQ Open, but could we build an idea around what happened into the NASDAQ? Of course we could. So today, again, we got lucky. We had a draw which looked really obvious on K period. What's K period? The London Open. And then we broke up, right? Could we get the expected value on this, right? So we had the draw on K. We started to build up. You get long, 24 pips. To the higher Asia, that's 54. Is there room there? We need to be a bit higher, maybe 60 ticks to realize some kind of reasonable expected value. Did we get that before the US Open? Absolutely. Bottom line is that this event occurred twice. Is it repeatable? We need to do a back test to see if we get a sweep every London Open. I know we don't, but the bottom line is that when you see one and you've built an idea around the London Open, now you've got a repeatable event, which is the London Open, and then now you've got an idea to build around. So that's a framework, right? I'm giving you a frame of reference. You could discover more around this. You could find more nuance. You can decide on the time frame you trade. You can decide on the point you want to get in. You could refine it into a strategy, into something that becomes repeatable every single day. And a lot of that is what's missing in today's traders, because you might not see a sweep at every London. What do you do then? Do you move your time frame now to the US session because you didn't see a sweep in London? Are you going to try and be erratic around the trade? For demonstration purposes, I could do these trades and show you, but are they the trades I'm going to do when I've do my own trading? Probably not, because I've got my own setup, my own repeatable event, something that pays me every day, and that's what I'm going to do. If someone came to mentor, and let's say they live in Japan, what I'm doing might work for them, right? Because I live in Japan. But let's say someone lives in Russia, and then I start to show them this, right? They live in the United States, and I show them they might think, yeah, what you're doing is really good, but I don't think I'm going to be able to do it. I need to go to someone who's going to teach me something that I can do, because what you're teaching, I can't do. So if you teach someone, you need to be able to teach them on different frames of reference that might be suitable. And that's what I try and do here, is conceptually give you a rounded idea. And then I give you a frame of reference that you can now start to build something depending on where you are. So I've given you two frames of reference, the London Open, the NASDAQ Open. Those are two frames of reference that you can use. Point in case. We'll talk more on the profile, but if I needed to stop this, I need to bring this thing at this point in time, because I know that this is the point through the lectures where you need to know what you need to do, right? So hopefully that started to give you guys a concept of how you can start to build a system or strategy that's going to work for you in the long term, right? It's all good understanding conceptually liquidity sweeping, that, and I've seen people say this. I was reading something the other day, and a trader was saying that, I've learned everything, and I still can't execute on it. What am I doing wrong? But there you go. This is it. Till the next lecture, guys. Adios.